Hey everybody, how's it going today? Welcome to this video for Business Math and Calculators. This is the video for Module 57, which deals with mutual funds. We've been talking in previous videos about stocks and bonds, and so mutual funds are another type of investment that you might be interested in. And so we're going to talk through how to interpret a mutual fund quote and do some different calculations based on that information. So with that, let's jump into a couple of sample problems. All right, so here we go with mutual funds. So sample problem number one, we are given a mutual fund quote. So again, like a stock quote or a bond quote, there's certain information that you find related to mutual funds. Mutual funds are a little bit different in the sense that rather than being like a stock in a particular company or a bond for a particular company, mutual funds are more like portfolios of funds where they're maybe a little bit safer than an individual stock in the sense that your money is spread out over a grouping of stocks, and then based on that combination kind of results in whether you are making or losing money on your investment. So a little bit different kinds of situations. Basically, a mutual fund is a combination of stocks and bonds put together into a portfolio that you invest in. All right, now, when it comes to the mutual fund quote, the information is a little bit less than what you've seen in the stock quotes and bond quotes. Basically, you've got the fund name, you've got what's called the NAV, the net asset value. You've got the net change, which shows you how the price of that mutual fund changed from the previous day. And then you've also got the rate of return on that mutual fund. So with that, let's calculate a couple of things. Number one, let's start with part A, which is asking for what was the NAV on the previous day of trading. This is done just like we did with the stock and bond quotes. You take the NAV and then the net change, and that net change tells you how it changed from the previous day. So when you put them together, you just do the opposite of the sign that is on that net change. So in this situation, we're going to take today's NAV, 2681, minus the 0.16, which was the change. And so the closing price on the previous day was 2665. Okay, I apologize for my typo on the screen. It should be 2665. So sorry about that. Please forgive me. I must have been tired when I put this PowerPoint together. Anyway, 2665 is the closing price on the previous day. All right, let's talk about how much it'll cost to purchase some shares of this mutual fund. First thing to note in Part B is this is what's referred to as a no-load mutual fund. And what that means is that there's no commission being charged. You can have situations depending on who you're working through and depending on the type of fund where they might charge you a commission to make purchases and sales of these kinds of funds. So it just kind of depends. If it's a no-load, there's no commission. So we can just calculate the cost pretty straightforward. Essentially what you need to do is you need to take the NAV value for that particular fund so the closing NAV at the end of the day, and multiply by the number of shares that you want to purchase. And so in this case, for 250 shares, it's going to cost us $6,627.50. So there you go. All right, last thing is based on the quote, how much total interest can be earned on these 250 shares? All right, basically to calculate this, what we need to know is what is the rate of return. And that is the percentage in that last column, the 3.9% is the rate of return. So if we invest in the 250 shares, so the $6,627.50 is how much we spent to buy them, multiply that by the interest rate. And so for this investment, we would expect to earn $258.47. So there you go. That's how much you'll get back by investing in these funds in terms of the amount of interest that should come back to you. Obviously, the higher the rate of return, the more interest that you'll earn, and the better you will do on that particular investment. All right, let's look at one last problem here. So let's see, suppose you want to invest in a no-load mutual fund, so again, no commission, that yields 7.9%. If you want to earn $2,000 in interest each year, how much should you initially invest? So basically, this is just going back to calculating, based on your investment and an interest rate of 7.9%. what do you have to start with? What do you have to basically multiply by to get 2,000? So we have a little mini equation that we're going to solve. X represents our initial investment. 7.9% written as a decimal is 0.079. We want that to ultimately equal $2,000. So to do this, we just need to do the opposite in solving the mini equation, divide by 0.079. And so our investment needs to be $25,316.46. If we purchase that much in our mutual funds and the rate of return is 7.9%, that will get us $2,000 in interest per year. All right, so there you go. A couple of quick problems dealing with mutual funds. Hopefully the examples are helpful in figuring out kind of what the meaning of the different terminology is associated with mutual funds and how to interpret the quotes that you find in a newspaper or other source that you use. If you have any questions about calculating things associated with mutual funds, please make sure you reach out and ask. I will be more than happy to help you out with anything that you need. Otherwise, I hope that you have a great day. Thanks for watching this video, and I will see you in the next video.